Some tax deductions sound amazing until you actually try to use them. In this episode, we're breaking down 5 deductions that sound great on paper, but usually turn into a mess. From security dogs to photo shoot makeup, we'll tell you which ones to approach with caution and why we often steer our clients away. If you're a small business owner who's ever asked, can I deduct this? This one's for you.
Welcome and thanks for joining us today. Sean and I are excited to talk about this. So, when we say we love to hate these deductions, it's that they're there. It's just there's more to it than I think is initially presented. So, our first one out the gate, we're actually going to talk about entertainment expenses, which aren't deductible. So, it's kind of funny because people will go and spend money on entertainment, and that would be golf outings, taking people to concerts, stuff like that. So, that
Broadway shows.
Broadway shows. And they're like, well, I took my client. Or I think the big ones I hear are like memberships to like yacht clubs or boating clubs or sailing clubs and stuff like that, or memberships to country clubs are a big one. And they'll say, hey, it's for networking. That's why I'm doing this. And you used to, like, there used to be ways to deduct this. There used to be options to like section this off depending on what was going on. And when we got the new tax laws back in 2017, which now are the old tax laws, they went away. You cannot deduct them for tax purposes. You can still deduct them for business purposes. You can still put them on your profit and loss. You just have to know your tax accountant's coming back and writing them back in as taxable income. And so I think this is one that I just, again, love to hate, is that I have this discussion and sometimes it turns into a fight with people to be like, no, I'm sorry, like it sucks, but you can't take this. I'm happy to put it on your profit and loss statement. I'm happy for you to see it and know that you spent that money. I'm just not allowed to put it onto your tax return.
Yeah. So don't think of it as a tax deduction. Like, still do those things, still pay for it with business cash, right? Like, it's still a perk to clients and a way to help you earn business or all those different things. But you just can't think of it from like, oh, if I go spend this much on a membership, then I'm saving taxes. Plus, I get all the perks of this thing.
Right. And it's just, again, one of those examples of the tax tail can't wag the dog. Like you have to accept it that sometimes things are great business decisions. They're just not good tax ones.
All right. The second one we're going to go into is probably one of the more abused expense item in business, and that is meals. And so there are people out there that think that, I'll just write off or I'll just like charge all of my meals because like I got to eat. It's like, well, you also have to get dressed and your clothes aren't deductible. We're going to talk about that one, I think, in a minute. So this one's frustrating from a tax standpoint because meals are 50% deductible. Again, from like in your business can pay for 100% of that meal. But when it comes to tax time, your tax preparer is going to add 50% of the cost of the meals for the year back in. So it becomes taxable income. And so those meals, they need to have a business purpose. They need to be with clients or prospects or networking or any of those types of situations, real business situations. It's not just your morning coffee or your lunch because you decided to pay for it through the business. It has to have a business purpose behind the meal, and you need to have solid records of what that meal was for. It doesn't hurt to have like, well, that was a networking lunch with so-and-so attached to a receipt so that it can't be fought on. I do think this is one of those ones where it's like, we do pay attention to the percentage of your expenses that meals make up, right?
Yes.
Because that's where it's going to be a red flag for the IRS to come look even deeper. But overall, you just have to keep in mind, it's not 100% deductible when you charge that meal to the business.
Right. And it's another one that I say I love to hate because one, alcohol is considered entertainment. So if we're going out and we're having wine, now I need to know ridiculously what part of that dinner was alcohol because I have to shift that back up to your 100%, right? And then I've seen people who work from home be like, well, my groceries would count, right? Because like they're food to feed me at my house. Well, no, they don't count. And then actually I just saw like the new tax bill OB3 or whatever set off a lot of discussion about like snacks in the office. That used to be something that we easily just wrote off and said, hey, no problem. It looks like that's still the case, but there was so much discussion around it because now if you provide meals, I'm thinking more of like the tech places where they get like the free breakfast and the free lunch. If you don't add that in as a taxable benefit now to your employees, you don't get to deduct it as a company. So like that law is shifting and has stirred up a lot. So again, meals is just one of those where it should be easy. It should be something that I just get to deduct, right? And It's just not. And so it's so hard.
Because there's even the piece of like, well, if it was a team training,
Mhm.
that is 100% deductible.
Yeah.
So, like, we track that in a different way because it was for the whole team
Yeah.
because you had a training or you were like all working through some big crunch, something like that. When the whole team is involved, you can deduct all of that.
Yes.
It's just not cut and dry when it feels like it should be.
Right. So yeah, just one of those, again, love to hate. So as we move on, marketing expenses, I think, is another one. So that's the broad category. I think the piece that really is that like love to hate relationship are the clothes and the makeup and the nails if you're female and do those things. Because I think again, we get the impression, well, I did this all because my appearance matters and how I look matters, even though maybe I am a tax accountant or I am a marketing agency, whatever the case may be. If you're not like an actress in Hollywood, which just seems like a small subset, like that's great. Your clothes do matter, your appearance does matter, but not at a point of deduction. And that's hard, especially if you go do branding shoots or something like that. I think there's this feeling of like, well, everything related to that I should be able to deduct. And again, it's just not that way. There are pieces. I think I've told clients before, if you buy an outfit specifically for a photo shoot and you donate it the next day, I'm a lot more inclined to say the sole purpose of that was that photo shoot. So we're probably talking about something that could be deducted, that it was a marketing expense. But if you buy it and you continue to wear it, well, that's just like an everyday outfit, like anything else, a news anchor, whatever the case may be, that just has like guidelines on what they wear. Makeup the day of, like buying your foundation, not deductible. Going to a makeup artist the day of, that is deductible. And so then back to the tax wagging the dog, the tail wagging the dog of, can you afford to do it? And if you can, great, go and take that deduction. If you can't, just do it yourself and forego that deduction.
And this is the one where we've had our episode on social media tips for
Mhm.
things, and they say, well, just put your logo in all your clothing and then it's deductible. Not true.
No.
Just plain not true. Can you buy clothes that have your logo on it? So team shirts and all
Yeah.
of that. Yes. And those are deductible and they're great things and they're advertising and whatnot. But just hiding your logo somewhere tiny just to call it a branding
Yeah.
outfit. No, absolutely not.
I think gifts get abused a lot under here. I don't know if
Mm,
you've seen it, but I've seen gifts get abused. Not abused, but the gift rule is dumb. I probably should have added this as one of ours because it's
horrible.
$25 per person per
Horrible.
year in 2025. Like that just doesn't get you much, right? If we brand it, it does start to shift into marketing, right? So if we are sending Yeti mugs with our brand on it, now we're looking better. Pens, papers, all of that. Now we are shifting to marketing. As long as that's the intent and you're happy with it and you're good with it, great. But like again, we can't just go take whatever random piece that wouldn't traditionally be marketing and put our logo on it on the inside pocket where nobody can see and say, hey, that's marketing. Because the
Yeah.
gift rule is stupid too.
Yes. I can't believe they've never raised that.
Indexed for
It's
inflation.
ridiculous.
That'd be great. Great place to
Right,
start.
right. Yes. The next one, which almost feels like should be on our social
Social media.
media, security dogs. So the logic here is that like my dog is there and guards me. I work from home. They're at the shop. They're at the office, wherever. Can I deduct his food, his vet, his whatever? Like, okay, first of all, unless it is a trained working dog, that dog, I don't know about yours, but someone's more likely to trip over my dog and hurt themselves than my dog actually alert to anything. They'll be like, "What are you doing here? I'll show you where my owner is sleeping."
Please follow me. And if you can give me a treat, you are my best friend
Yes.
now.
Yes. I'll go with you. So unless your dog is a trained working dog, and that's primarily what their purpose is. So if you have a security firm and you have dogs that are, they're assets. So they're trained,
Mhm.
they're like employees. That is a very different situation than just if I had a dog curled up on my chair back there and I said he was guarding me.
Yeah, I've seen both the guarding piece. I've seen the marketing piece, like put it in your dog and your marketing material. Now we're deductible. And the love to hate is the confusion too. So if it's a medical dog, so if we're talking about a guide dog or someone who's there for like medical purposes, well, that can shift to a itemized medical deduction expense. And sure, let's talk about that piece. But it's just the blanket piece of like, oh, well, they bark. And so they're a security dog. You're not working at a junkyard or something like that where it makes sense to have one. Maybe try this security system first would be my recommendation.
Yes. In this day and age, security system would probably do you better.
I really would. So our fifth love to hate, and this is, again, would have done well on either episode about social media or this one, is the Augusta Rule. So if you're unfamiliar with this rule, it's that you can rent out your home for up to 14 days without paying taxes on that income. All started because of the Augusta golf tournament, and they didn't have places for people to be. So they created this rule basically and allowed that deduction. And so that has since morphed. Like, I really love it if we're talking about something like a tourism Augusta thing. I live where like Berkshire Hathaway days are really big and all of our hotels sell out. I live where the CWS is. All of the hotels sell out for that. So I have considered like, oh, that would be really great if we had a place to go for 2 weeks to rent our house out for those events and make some tax-free money. The problem is it has been abused to say like, hey, if you hold your company meetings at your house, then you can basically rent your house to your company for those meetings for whatever their fair market rate is. And it's been abused so much that we're seeing court cases now come out with folks who have done just a ridiculous rate that didn't apply. We've seen folks go back and amend prior years to like create this expense and income. It was never done right. So it's one where there's just a lot of steps to take. And it's sometimes just not worth the squeeze. It is not worth like the 24 cents you're going to save in order to do this and to do it in a way that would stand up on audit. And so that part, I think it's just the complication part that always drives me a little nuts of like, you have to hold the meeting. You can't hold it in the same space that we're maybe taking an accountable plan for. So you have to section that off. You have to keep records of those meetings. I don't know how like a solo S Corp can do it because like it's just you who you're meeting with. And some will say like, have your meeting on Zoom with your accountant. And then, but did you really need to rent it? Again, just love to hate this one. I think in many ways it can work well if you live in a tourism area, like totally worthwhile to sit there and rent your house out for a couple of weeks and get that tax-free income. I think just when we start talking about it from a business standpoint, it gets really complicated and no one wants to follow the rules, but they want to take the deduction.
Shocker.
Imagine that.
I don't want the pain. I just want the gain.
Yes.
Don't we all?
Yeah. And I'd say it's getting riskier too. That's the other piece is it used to probably be like a low flying one. But now that we're seeing these because the most recent court case was only a couple of years ago, it got decided. It's on the radar now and it's worth being cautious with.
Thank you, social media influencers.
Yes.
Everything that they're screaming, the IRS is what? We'll give them a 5-year lag because they're slow. So, if it's popular now, in 5 years, they're coming after it.
Yep.
And
I kind of keep waiting. Like, is the IRS verified anywhere on social media? I would love to see if they're like following some folks. And, like,
the head of the IRS is like silent
now.
Creeper. I don't even know who that person is, but they're just like,
we've had 5 this year, so good luck. I don't know if I know who it is at the moment. It's someone else who's acting. I don't think we've kept ahead of the IRS this year so far. It's been a wild ride.
All right, so the last one is a bonus one. We talk about this in a prior episode, but we're going to talk about the lovely S Corp election. And so this is a very popular tax deduction or tax strategy, I should say, not tax deduction. And it's making that S Corp election when you are an LLC. And it is great. And it does save on taxes, but there are also complications with it of having to file now. So you have a separate whole tax return for your business versus just filing a Schedule C as part of your personal return. There is documentation that comes with being a corporation, and you need to have meeting minutes and all of these things, your annual report, all of this stuff has to happen. And it's not just a simple strategy. And especially as we see the tax code changing, might not even be the best election to make in the future. So there's more to come on that. But I can't talk about like the tax strategies we love to hate on without at least mentioning that piece because we see so many people just make the S election out the door. I mean, we've been consulting with clients on that recently where they were elected into it. They were never at a profitability level that warranted the S election at all, or they elected it out the gate and set up a corporation instead of an LLC. And now they're like, well, I don't want to pay for a corporate tax return this year. My business isn't even off the ground. And it's like, I'm very sorry. The IRS is expecting your tax return.
Yep.
Even if you close your business today, it was open for part of this year and you've got a tax return that has to be filed. And I know that sucks,
And you have
but
to do
that is
payroll.
reality.
Yeah. Got to do payroll. And what you
Gotta do
cannot do, this is the other reason I love to hate an S Corp, is if you find an inexperienced tax person who's put this together, what they will do is if you didn't run payroll, they will just take your profits and go toss it onto your Schedule C. And so that you claim, like you pay Social Security and Medicare that way. And that's just not how it's done. So like you need to do the steps. And I totally understand. Like I will say if you have to make it even, like that's a decent way to at least pay the taxes in. But it's just again more of that like quick strategy that you got sold without all of the steps that need to be followed. We
Yep.
love these things. They're great. They can be a great asset to your business. You just have to do them right. That takes conversations and effort and some research and knowledge and not just selecting it on your 2553 and running with it.
Yes. Yes. All good conversations to be having with a real tax professional. I'm not going to qualify what's real right this moment because I've got some feelings about the ones out there that call themselves real. So we'll cage snarky Shauna and we'll wrap this up and just say we're not here to crush your dreams of tax deductions.
Mhm.
We just want you to use them properly and we want your business to be audit proof. We don't want you to have to go find a good tax attorney because they are expensive. So let's just do things right, have our knowledge ahead of time, make good deductions, make good decisions.
Now that we've talked about the ones we love to hate, if you would like to learn more about the ones we do love, you can head on over to the link in our show notes and sign up for our like 5 email sequence that we will talk about the deductions we love, how to use them the right way, and it'll put you in for more information in the future.